Today, we'll be taking a look at a stock that has been on a total roller coaster in the past year. It's up over 200% in the past year, down over 55% from its peak in January, and up over 50% in the past few months. That stock is Plug Power, ticker symbol PLUG. So here's the agenda. First, I'll go over the company, their products, and their history. Next, I'll take a look at their financials. Third, I'll talk about their growth. And finally, we'll take a look at some of the bearish arguments and my thoughts on the company. So let's waste no time and get right into part number one, which is what is Plug Power? Well, Plug Power is an energy company that specializes in providing hydrogen fuel cell solutions to businesses across the globe. They're currently considered one of the top fuel cell companies, and they have a market cap of $15 billion. Now, if that makes no sense, let's take a step back and go over exactly what hydrogen fuel cells are, since understanding this is important to understanding the company. Now, if you already know what these are, go ahead and skip ahead to the timestamp on the screen. With that said, a hydrogen fuel cell is an electrochemical power generator that combines hydrogen and oxygen to produce electricity. Simply put, a hydrogen fuel cell is a device that sucks in hydrogen and oxygen, then converts it into energy. This energy can be used to power anything from drones to semis, and some people see it as a replacement for gas and battery-powered vehicles. This is because hydrogen fuel cells have a few advantages over other energy sources. For one, it's a very effective way to store energy. When energy is stored as hydrogen in the form of liquid gas, it'll never dissipate until it is used. This makes it good for emergency generators and mission-critical energy applications. Compare that to batteries, which lose the energy stored in them over time and need to be periodically recharged even when they're not used. Hydrogen fuel cells are also more efficient than gas energy. According to the U.S. Department of Energy Hydrogen Program, a standard car with a combustion engine has around 20% efficiency, whereas vehicles using hydrogen fuel cells have around 40 to 60% efficiency. This means that there is about a 50% reduction in fuel consumption. Hydrogen also has virtually zero emissions, and the only exhaust it emits is water. Plus, it has a consistent level of performance, just to name a few other advantages. To capitalize on this, Plug Power provides a variety of solutions from hydrogen generation, liquefaction, logistics, equipment, and aftermarket services. This makes them vertically integrated, which was a big deal for their business. That said, materials handling, which is just a fancy term for forklifts, is their core business right now, where they claim to hold 95% market share. In this area, Plug sells their Gen Drive and Gen Fuel solutions to clients such as Amazon and Home Depot for their manufacturing and distribution centers. These two solutions are used to power and fuel forklifts, which eliminates battery charging. They say this increases productivity by 15 to 25%. In addition to forklifts, they're also working on extending this technology to semis, aircrafts, data centers, and microgrids, just to name a few areas. Currently, Plug Power generates revenue by selling products and services through their four main business segments. Fuel cell systems and related infrastructure is their largest revenue stream. This comes from the sale of fuel cells, such as Gen Drive, which is their top product, as well as their hydrogen fueling infrastructure. In 2019, they generated about 65% of their revenue from this area. Fuel delivered to customers is their next largest segment, and this comes from selling hydrogen to customers. This segment makes up about 13% of their revenue. Purchase power agreements is their next largest segment, and this comes from generating power for customers. This makes up 11% of their revenue. Finally, they perform services and maintenance on fuel cell systems and related infrastructure, and this makes up 11% of their revenue. Now, while all this sounds interesting, Plug Power almost didn't make it to this point, and at one point, as I'm about to share, the company was on the verge of bankruptcy. Plug Power was founded all the way back in 1997 as a joint venture between DTE Energy and Mechanical Technology Incorporated. During this time, Plug Power was focused on fuel cells for the indoor forklift market, where they worked with customers like Walmart, Nike, BMW, and Home Depot. Shortly after, the company went public in late 1999, right before the dot-com bubble. Then in 2000, the stock price peaked at $1,500, but over the next decade, the wheels began to fall off. Adoption of hydrogen fuel cells was slower than expected, and execution issues resulted in the company falling 6 to 9 months behind on some projects. At this point, they'd lost money every year since inception, and Plug Power was on the verge of bankruptcy. Shareholders were getting diluted like crazy, and their shares outstanding increased from 38 million to 176 million. In 2013, their stock had fallen over 99% and hit 12 cents a share. Since then, the company has recovered by raising more money and making a string of acquisitions to help boost their business to where it is now. But it's been a very bumpy road. So let's jump into part 2, which is their current financials. Since 2004, Plug's revenue has increased nicely from about $16 million to $229 million in 2019. Although their yearly growth has been very inconsistent and revenues have declined during 5 of those years. Now if we move over to their 2020 revenue, Plug Power did something that I've almost never seen a company do, and that is post negative revenue. In 2020, Plug Power lost $93 million in revenue. This is because they waived the vesting conditions on warrants issued to Amazon. These warrants are issued by the company and give the holder the right to purchase a stock at a specific price at a specific date. But these cost money, and the money comes off the company's revenue. Plug Power incurred $400 million in costs with this move. This really skewed their 2020 numbers because although the company recorded record billings last year, they reported negative revenue. Moving down, Plug Power's gross margins have historically been very negative, although in recent years they've hovered around 0 to 5%. These negative to low margins have resulted in the company losing money each year since their inception. That said, in their recent conference call, the company said they expect to be a 30+% gross margin business by 2024, so hopefully that will lead to profitability. Moving over to their balance sheet, the company currently has $4.2 billion in cash and equivalents and $668 million of total debt, putting them in a strong financial position right now. They also have $5.7 billion of total current assets and $191 million of total current liabilities, putting their current ratio at over 25, which is excellent. Keep in mind though that these numbers have been boosted by the company raising a lot of money recently, which has resulted in shareholders being diluted. So why are people optimistic about Plug Power? Well, it all comes down to growth. For starters, the hydrogen industry is expected to experience rapid growth. An Industry Arc report projects the hydrogen fuel cell market to grow at a compounded annual growth rate of 65.86% from 2020 to 2025. A Purdue research study projects the worldwide hydrogen fuel cell market to grow at a compounded annual growth rate of 21% over the next 10 years. So they operate in a growing industry, which helps set up the company's aggressive growth plans. This year, Plug Power's revenue is projected to grow over 100% compared to 2019, and next year, their revenue is projected to grow nearly 55%. Plus, the company recently increased their 2024 billings target to $1.7 billion, which is more than a 40% increase from their previous target. To achieve this growth, they're focusing on growing 3 business segments. 1 is their materials handling, 2 is their hydrogen power infrastructure, and 3 are modular power arrays for stationary power. The company is projecting materials handling to contribute $750 million in sales for their $1.7 billion 2024 sales projections. The plan to grow this segment is expand their existing relationships, add new customers, and increase their global reach. They're particularly focused on Europe, where their goal is to become the leader in materials handling. For their hydrogen power infrastructure business, the company is envisioning over 500 refueling stations by 2024. Currently, they have 100 stations around the US, which gives them the largest hydrogen network in the world. They're also looking to have 5 green hydrogen plants in the US by 2024. These will help the company break apart water and create liquid hydrogen, which can be used as fuel. They already operate 1 hydrogen plant in Tennessee and are building 2 more in Pennsylvania and New York. Lastly, the company is looking to grow their modular array business. These are power arrays that are meant for long-term storage, since they can be filled up and will last forever, unlike a battery. So they're used in the data center, microgrid, and maritime industries. Many data centers are looking to eliminate diesel, and because of this, Plug Power is planning on working with some of the world's largest data centers this year. In addition to these areas, the company is also looking to grow their business through partnerships, specifically in Europe and Asia. Earlier this year, Plug Power announced a 50-50 joint venture with Renault, which is a European-based automaker. They'll work on the research, development, manufacturing, and sale of fuel cell-powered electric vehicles for hydrogen solutions. They're targeting over a 30% share of the hydrogen-powered light commercial vehicle market in Europe by the end of the decade. In Asia, they announced a partnership with SK Group, which is one of the largest companies in South Korea. The goal is to provide hydrogen systems, fueling stations, and electrolyzers to the Korean and Asian markets. So they're working on extending their global reach, and so far investors have loved both of these partnerships since these will help the company break into the on-road vehicle markets and stationary markets. They've also stated that they're going to try to sign additional partnerships to try and grow their business since they've been successful in this area. So what are some of the risks and bearish arguments with Plug Power, and what are my thoughts? Perhaps the most common concern brought up with Plug Power is their sky-high valuation. They're currently not profitable, so we can't look at their PE ratio, but we can look at their price to sales ratio, which was around 36.5 last quarter. This is extremely high. Even when we look at their 2024 projections, we'd get a price to sales ratio of around 9.7 based on their current valuation, and that's assuming they meet their projections. Another concern is that they recently announced they were restating previous financial statements. Fiscal year filings from 2018 and 19 and quarterly filings from 2019 and 20 needed to be restated due to accounting errors. I know a lot of people get concerned when there are financial errors, so even though they've already completed their financial restatements, some people don't trust the company after this incident. Many people are also concerned about whether Plug Power can succeed in the on-road vehicle market. Hydrogen fuel cell adoption is still in its early stages, especially for vehicles. In the vehicle market, battery technology is more developed and infrastructure is much more built out, which is a concern since new buyers might choose the more widely available options. In the US, there are 40,000 electric charging stations open to the public, compared to only 44 hydrogen fuel charging stations open to the public. Additionally, individuals like Elon Musk don't think hydrogen fuel cells are good for vehicles. He said he thinks they're good for storage, but they're not meant to be a fuel source. Plug Power also has very heavy customer concentration, and in 2019, 49.7% of their revenue came from 2 customers. They've also never been profitable, which is another common concern brought up. So what are my thoughts on the company? Well, after analyzing Plug Power, I think they're a unique company, and right now, I would probably consider them a high-growth spec play. Both the company and their industry are projected to see strong growth, and they currently are in a strong financial position, which is nice. That said, I do have some concerns. For one, it seems to me like the company is trying to grow a lot of areas at once, and they're not very focused right now. Initially, the company was focused on growing their materials handling business, but after they did that, they've tried to grow every area of their business. Look no further than their recent investor presentation, which is 117 slides and is really hard to follow because it covers so many different areas. I understand that some of these areas are important to their growth, but I think they could be spreading themselves a little too thin. I also think it might be a little too early for me, since hydrogen hasn't really been proven out yet in the vehicle industry. I would like to see more infrastructure be built out and more vehicles using hydrogen before I could have confidence in hydrogen over battery technology. To add to that, the company's yet to turn a profit, and their valuation is just too high for my liking. So although they have some interesting things going for their business, I also have some concerns, which is why I'd consider them to be a high-growth spec play. With that said, if you liked the video, don't forget to hit the like button, and if you want to see more videos like this one, please subscribe down below and hit the notification bell. Thank you so much for watching, and I'll see you in the next one.